same rules apply to that due date as usually apply to that April due date. And so if make sure that you get your tax return filed if you can by that July 15th deadline. Otherwise, taxes or rather penalties and interest will begin accruing. You can avoid a late filing penalty by filing an extension if you can't file your tax return by July 15th. But an extension to file is not an extension to pay. And so if you do have a balance due, even if you file that extension, it's just really important to pay as much as you can at the time that you file that extension to avoid any interest or late payment penalties. Yeah, so the IRS has payment plans available, and there are two common types of payment plans. If you think you'll be able to pay your balance due within 120 days, you can get on a short-term payment plan, and there's no fees associated with that. If you think it'll take longer to pay that tax debt, then they have an installment agreement. There is a cost associated with that. Low-income taxpayers can get a waiver for that cost, but yeah, so they have payment plans available, and it's really easy to get on them. And so we highly recommend for people who can't come up with the money out of pocket to cover their whole tax bill, get on an installment agreement with the IRS, and our tax pros can help you do that as well. So if you file an extension, you have until October 15th to file and avoid a late filing penalty. And that late filing penalty is significant. It's up to 5% of your balance due per month. So it's a really significant penalty. So filing that extension avoids that, but it only avoids that until October 15th. And what it doesn't do is prevent that late payment penalty and interest from accruing. So that's just something to keep in mind. If it gets you out of that big late filing penalty, but it doesn't help you avoid the smaller late payment penalty and any interest that'll accrue. Yeah, so that increased unemployment benefit is really significant for a lot of people, but it also increases the taxability of those unemployment benefits. So unemployment benefits are taxable at the federal level. Most people they can elect to have federal income taxes withheld when they get their unemployment benefits, but most people don't elect to have that withholding. So what happens is they go in to file their taxes next year, and they're surprised that they have to come up with some money out of pocket to pay a tax bill that they don't normally have, just because they received unemployment and didn't have any taxes withheld from those unemployment benefits. Taxpayers have two options. If you're applying for unemployment benefits, you can elect withholding on your state Department of Labor website. Each Department of Labor website will have a form, and you can elect to have withholding both at the federal level, and if your state has an income tax, you can have state taxes withheld as well. So that's the first recommendation. If for whatever reason you didn't elect that, or you just don't want to elect that because you need the cash now, it's just important to know, you talk to a tax pro, figure out what your tax liability for next year is likely to be so that you can start setting aside money. And you can either make an estimated payment directly to the IRS, or you can set aside money in a savings account, or just hold it aside so that you're prepared to pay that tax bill next year. Well, so a few years ago, all of us would have been able to deduct these work from home expenses that we've incurred. But under the law that passed in late 2018, those unreimbursed employee business expenses, including home office expenses, are no longer allowed. So they're not deductible for employees at the federal level. However, self-employed individuals and independent contractors can deduct those because they're considered small business owners, and they can continue to deduct them as business expenses. So if you're an independent contractor or self-employed individual, make sure that you're documenting those expenses. You can even deduct a portion of indirect expenses like your mortgage interest or your rent or utilities. So just make sure you're tracking those expenses. And if you're an employee, track those expenses anyway, because they may be deductible on your state return, or it's always possible that new legislation accommodates taxpayers in this unique situation. So keep track of those records. So the Paycheck Protection Program loans that a lot of small business owners applied for and received, the loans themselves are not taxable. If they're forgiven, they're also not taxable. However, the Treasury issued some guidance that muddies the waters a little bit here. So if your loan is forgiven, you can't deduct the business expenses that you paid with those loan proceeds that were ultimately forgiven. And the effect there is that it doesn't really matter. It has the same effect as if the proceeds, rather, as if the forgiveness was taxable. As it stands right now, it'll be a little bit of work. You won't be able to deduct those expenses that you paid with the forgiven loans. In the same vein, the people who are working from home, if you're commuting, if you normally commute to a neighboring state, or you normally commute from a suburb to a city, if that city has an earnings tax, then it's going to be really important that you document the days that you are working from home, because you can likely apply for a credit or claim a credit when you file your city tax return next year and get some of those city earnings taxes back. Likewise, if you file a non-resident return in a normal year, and this year you're working more from your resident state, just make sure that you're tracking the days that you're working from home, because you're going to have to figure out how to allocate income a little bit differently than you normally do when you file your state tax returns.
That sounds really complicated.
Yeah, it's going to be complicated. And yeah, it's going to be complicated.